Hey everyone, Wahidah here. Today we're breaking down mutual funds, ETFs, and index funds, and which I prefer. Also, why is my pimple so big? Do you see this? Oh, whatever. I thought it'd be gone by the end of the weekend, but it's still here. Whatever, my hair's cute. Let's go. My first introduction to investing was when I was at my first job after college, and they were going over things. So they had like a town hall meeting and they had the employees there. There was like 50 of us, and HR was there just explaining the benefits, like a town hall kind of meeting. And words like HSA and 403B were thrown out there, and like our investment options came up. And I just remember feeling so lost, like so fucking lost. I didn't know what was being said to me. But I looked around that room, and there were about 50 people in that room, and they were nodding their head like they knew what was going on. And I was like, oh, it's me. Like, I don't understand what's happening. I'm behind financially, but everyone else has it figured out. So I went home that day and I did some Googling. And after 9 years, I haven't stopped. And here we are. So before we go into the numbers, let's define mutual funds, ETFs, and index funds. So number one, mutual funds. So mutual funds are like a pool of money from many different investors. It's managed by a professional fund manager, like one or multiple. So think of mutual funds as like a financial potluck where like a professional chef, the fund manager, like combines ingredients, the money from many like dinner guests, right? The investors. So they're collecting all these ingredients, they're collecting the money, and they create a dish of very diverse ingredients of like stocks, bonds, and securities. Everything's done for you, right? You just hand over the money, and the fund manager does everything. It's one of the easiest way for you to be able to invest in a very diversified way, in a very cost-effective way, without having to think about what you're invested in and how to rebalance and all of that stuff. All right, an example of a mutual fund is this one right here, the Vanguard Target Retirement 2060 Fund. So this is a target date fund, and it automatically adjusts its asset allocation as you approach retirement or like your target date. And when it automatically adjusts, it's like the fund manager that's doing it, right? So with a target date like this, you can be fully diversified by buying just one fund. It invests in domestic stocks, international stocks, and bonds. So really, again, it's the most hands-off way to invest without getting like a financial advisor, right? So this is one of the most hands-off way to invest. You just hand over the money and then you forget it. The downside? Well, there's no customization, right? So you can't tell the fund, oh, go buy more stocks and less bonds. No, you just hand over the money. But low expense mutual funds can be a pretty solid way to invest. It can be a solid low maintenance option. Okay, number two, we have exchange traded funds, so ETFs. So this is also a pool of money from investors, but it can trade throughout the day like a stock, and it can track an index or be actively managed. So essentially like the Swiss Army knives of the investment world, right? So they're very versatile funds that trade like stocks, so they can be traded throughout the day, but they can contain like a whole basket of investments. So it can be very diversified. And depending on what you're wanting to invest in, it can track certain market indexes or sectors. An example of an ETF is this one, the Vanguard Total Stock Market ETF, the VTI. So the ETF tracks the entire US stock market. So if you buy this ETF, you're buying the entire US stock market. So when you hand over your money, you know you're quite diversified. But you're not buying any like international stocks, you're not buying any bonds, right? So to be quite super diversified like that target date fund I showed, you've got to buy multiple funds, right? And one major bonus of an ETF is that it can be bought on any different platform, right? So if you're on at Schwab today and you're like, I want to move over to Fidelity because I have my retirement from work there, it's easier to move an ETF in kind versus if you had an index fund. Index funds usually just stay on the platform that they're offered on. So if you're wanting to I want to move platforms, you'd have to sell that index fund and then move the cash over to the new platform and then buy whatever you had, which isn't terrible. It's just an extra step. If you had an ETF, that ETF could just move in kind. Okay, and number 3, we have the index fund. So an index fund is a type of mutual fund, and it passively tracks a specific market index, so it's passively managed. The index fund is essentially the follow the leader type of investing. So the index fund is aiming to mirror the performance of a specific market index, maybe like the S&P 500, right? So it's not trying to beat the market, it's trying to just be the market. So that's why it's quite passive, because it's just looking at what's this index that we're wanting to track and mirror, and that's what it buys at any given moment, right? So it's not trying to beat the market, it's just trying to be the market. So they can only be traded once a day at the end of the day. So it doesn't trade like a stock or an ETF, but usually that doesn't matter, honestly. We're not trading our index funds very often, right? Like we're looking to invest for the long term, so we're buying and holding, right? So if you're looking to do some day trading or buy and sell often, you wouldn't do it with index funds. And if you're interested in day trading, this isn't the account for you. All right, and an example of an index fund is the Fidelity Zero Total Market Index, the FZROX. So this index fund tracks the total US stock market, just like the ETF I shared earlier. So it's, again, you're going to be quite diversified within this index fund, but to be fully diversified, just like that target date fund, you just have to buy multiple index funds or a combination of index and ETFs. Okay. So now, remember at the beginning of the video where I mentioned that there's a place for all of these funds? It just depends on what you're looking to get out of them. And it depends on how much they cost, right? So we're looking at the expense ratio. So what's an expense ratio?